Welcome to the deep dive. Today, we're really getting into the weeds of Luxembourg's financial structures.
That's right. We're focusing specifically on the capital and, the financing side of things for SOPARFIs and investment funds.
Exactly. We've pulled together a lot of the latest info, aiming this squarely at you if you're a lawyer, finance pro, director, compliance officer, or company secretary.
Yeah, we'll unpack how these key vehicles are built and funded. SOPARFIs, but also the fund Alphabet Soup, UCITES, RIOFs, SIFs, SICARs.
Our mission, really, is to give you a clear, factual breakdown. What are the capital needs? What are the financing options? And crucially, what are the very latest regulatory changes saying?
Let's do it.
Okay, let's kick off with the SOPARFI. It's kind of a cornerstone for many international setups in Luxembourg, right? What's its main job?
Think of the SOPARFI Société de Participation Financière essentially as a regular Luxembourg company. Its main purpose, though, is holding financial participations, stakes in other companies, and managing the financing around those.
So it's not a special legal entity.
No, not in itself. It operates under the General Luxembourg Commercial Company Law, the big one from 10 August 1915.
Right. So compared to a fund, it generally doesn't have the CSSF breathing down its neck.
That's a really key point. Typically, a SOPARFI isn't under direct prudential supervision from the CSSF.
Which means faster setup, I guess.
Exactly. It can definitely streamline incorporation. But, and this is important, it means you, the stakeholders, really need to do your homework, your due diligence.
Makes sense.
And just a note, if the SOPARFI starts doing more than just holding and financing, like actual commercial trading, it might need a trading license.
Ah, okay.
And of course, if you use a SOPARFI to set up a regulated fund, then that fund part is regulated. Obvious maybe, but worth saying.
Got it. Okay, setting one up. What are the usual legal forms, and what's the initial capital looking like?
Well, the two big ones you see most often are the public limited company, the SA, and the private limited liability company, the SSR.
SAN, SARL, right.
You do see others like the Coupes A or the SE, but they're less common for standard holding structures.
And picking the form matters.
Oh, definitely. It impacts things like capital flexibility, how easily you can transfer shares, that sort of thing. It's a strategic choice.
And the capital needed?
For an SA, the minimum share capital is EUR 30,000. At least a quarter of that, 25%, needs to be paid in right away.
Okay.
The SARL has a lower threshold, EUR 12,000 minimum, but that has to be fully paid up from the start.
Fully paid. Any other initial things?
Yes, there's a statutory reserve. Each year, you have to put aside 5% of the net profit into this non-distributable reserve.
Until when?
Until that reserve hits 10% of the company's share capital.
Right, and a small registration fee, too.
Yeah, a fixed duty, currently about ER 75 when you incorporate. Pretty standard.
Okay, that paints the setup picture. What about what a SOPARFI can actually hold? Any limits on its investments?
That's one of its big advantages. The investment scope is really broad, very flexible.
So obviously, financial stakes in companies.
Yes, plus providing financing, like loans, to its subsidiaries, but also bonds, real estate, intellectual property, cash, loans it receives. Pretty much anything goes.
And unlike funds, no diversification rules.
Correct. No specific rules forcing diversification at the SOPARFI level itself.
Very handy. So how does a SOPARFI typically get funded for all this activity?
Various ways. Equity is the obvious one. Issuing shares, you can have different classes, nominative, bearer, though there are restrictions on bearer shares now.
And contributions beyond just the share value.
Absolutely. Share premium is very common. Contributions can be cash or sometimes in kind.
Like contributing assets instead of cash.
Exactly. Though for SAs and SCAs, if you contribute assets in kind, you generally need an independent valuation report to make sure the value is fair.
Okay, equity covered. What about debt?
Plenty of options there, too. Bonds, convertible bonds, subordinated notes.
Standard debt instruments.
Yes, but here's a really key feature in Luxembourg. The 85.15 debt-to-equity safe harbor.
Ah, the famous ratio. Explain that quickly.
Okay, so for loans between related parties, if the total debt doesn't exceed 85% of the SOPARFI's equity, the interest paid on that debt is generally tax-deductible in Luxembourg.
Big deal for tax planning.
Huge. Assuming, of course, the interest rate is arm's-length market rate. That's crucial.
And you mentioned hybrid instruments, too. What falls under that?
Right. Luxembourg's quite innovative here. Things like preferred equity certificates or PECs.
PECs? How do they work?
Well, for Luxembourg tax, the payments on PECs are often treated like deductible interest, usually without withholding tax.
Okay.
But depending on the structure, they might be treated as equity by the investor's home country. So potential advantages there. You also have convertible PECs, CPECs, adding more flexibility.
Interesting. And shareholder loans.
Very common. Again, subject to arm's length pricing and that 85.15 rule if it's a related party loan.
Makes sense. And LBOs, leveraged buyouts.
Yes, SOPARFIs are often the vehicle of choice for holding companies in LBO structures. You use debt to finance the acquisition, and the SOPARFI structure can sometimes allow for tax consolidation benefits with the acquired target group.
Right, bringing us neatly to tax. It seems central to the SOPARFI's appeal. Quick tax snapshot.
Definitely. Look, SOPARFIs are fully taxable companies, let's be clear.
Right.
But they benefit massively from the participation exemption regime.
Which means?
Which means dividends coming in from qualifying subsidiaries and capital gains when you sell those qualifying stakes can be completely exempt from corporate income tax.
Under certain conditions, presumably?
Yes, absolutely. Conditions like minimum holding percentage, maybe acquisition cost, holding period, and the subsidiary itself needs to be subject to a comparable tax.
Okay. What about interest payments? Out.
Generally, no withholding tax on arm's length interest payments made by the SOPARFI.
And dividends out.
There's a standard 15% withholding tax on dividends distributed.
Intrafor.
Treaties and directives. Exactly. That 15% can often be reduced, sometimes to zero, thanks to EU directives or Luxembourg's huge network of double tax treaties.
Got it. Anything else tax-wise? Net wealth tax.
Yes, there's an annual net wealth tax, usually 0.5% on the net assets, but exemptions can apply, especially for qualifying participations.
And for certainty, can you get rulings?
You can. Companies can apply for advanced tax agreements or ATAs from the tax authorities to get clarity on how specific transactions will be treated. Very useful.
Okay, that's a really solid overview of the SOPARFI.
Yeah.
Let's shift gears now to Luxembourg investment funds. It's a massive sector, right?
Huge. Luxembourg is maybe the leading global fund hub, and the CSSF provides really robust oversight.
And the rules are always changing.
Constantly evolving. The framework adapts to EU directives, international standards. It has to.
Compliance must be key then. AML.
Absolutely paramount. Anti-money laundering and counter-terrorist financing rules are critical across all fund types. You've got the main law from 2004, various CSSF regulations like 1202, and important circulars like 18698, and recent one, 248554 on summary reports.
And sustainability. ESG.
Yes, SFDR, the Sustainable Finance Disclosure Regulation, is vital now for disclosures. And there's also the regulation on cross-border distribution that funds need to follow.
Any very recent CSSF updates we should flag?
Well, just in March 2024, they issued Circular 24856. It updated the guidelines on protecting investors if there's a NAV error, a mistake in calculating the fund's value, replaces an older circular. Shows their focus on investor protection.
Okay, let's start with the most well-known type, perhaps, UCITES. These are the ones aimed at retail investors across Europe.
That's the one. Undertakings for collective investment in transferable securities, designed for retail, and they benefit from the EU passport, meaning they can be sold relatively easily across the EU.
Governed by a specific law.
Yes, the main law is the law of 17 December 2010, and they absolutely need CSSF authorization and are under its ongoing supervision.
What forms can they take?
You typically see the FCP, the Fonds Common to Placement, which is a contractual fund, no legal personality itself, managed by a management company.
Okay.
Or you have investment companies, the SICAV with variable capital, or the SICAF with fixed capital. And these can be single funds or umbrella structures with several sub-funds inside.
And the money needed to get one going.
The UCITS test has to reach minimum net assets of EUR 1,250,000. They get 6 months after authorization to hit that target.
Any special cases?
Yes, if it's a self-managed SICAV, the initial capital required is EUR 300,000.
Given they're for retail investors, I assume the investment rules are pretty strict. Borrowing limits.
Extremely strict. They have to mainly invest in transferable securities, things like stocks and bonds and other liquid financial assets.
Diversification.
Absolutely critical. Very detailed risk diversification rules apply, laid out in Chapter 5 of that 2010 law to prevent overconcentration.
What can't they do?
Well, uncovered short selling is generally a no-go. Direct investment in things like gold bars or certificates isn't allowed either. And interestingly, the CSSF confirmed a while back, August 2020, I think, that originating loans directly isn't an eligible activity for UCIs.
And borrowing. Leverage.
Very limited. Temporary borrowing is capped at 10% of net assets, generally.
Temporarily.
Yeah, short term. They can borrow an additional 10% if it's for buying real estate that's essential for running the fund's business, but the absolute total can't exceed 15%.
And using derivatives for leverage.
That's also capped. The total exposure from derivatives can't exceed the fund's total net asset value. So, quite conservative overall.
Very clear on UCIs. Okay, let's move into the alternative space. AIF's alternative investment funds. For the more sophisticated crowd, right?
Exactly. AIFs cater to professional and what are called well-informed investors. The main framework is the AIFM law of 12 July 2013, which brought the EU's AIFM directive into Luxembourg law.
AIFM, the manager, is key here.
Very much so. The Alternative Investment Fund Manager, the AIFM, is responsible for core functions like portfolio and risk management. And crucially, an authorized AIFM can get an EU marketing passport for the AIFs it manages.
And CSSF guidance.
Yes. Circular 18698 is a key one, giving detailed guidance on how the AIFM law works in practice.
Okay, within AIFs, we have different types. Let's start with RAF's reserved alternative investment funds. They sound faster to set up.
They generally are, yes. The RAF regime came in with the law of 23 July 2016, and it was tweaked a bit in 2023.
What's the key feature?
The big difference is that the RAIF itself isn't directly approved or supervised by the CSSF. The regulatory focus is entirely on its manager, the authorized AIFM.
So indirect supervision.
Exactly. That's what makes the time to market potentially much quicker compared to a fund needing direct CSSF sign-off.
Who can invest in a RAF? Still restricted.
Oh, yes. Only well-informed investors. That means institutional investors, professional investors under MiFID rules, or other investors who commit at least EUR 100,000. That minimum was actually lowered from 125,000 euros in 2023.
Ah, that's a significant change.
It is. Or, alternatively, investors who don't meet those criteria but are certified by the AIFM or another professional as having the expertise to understand the risks.
What about legal structures for RAIs?
They're quite flexible. Can be investment companies like a SICAV or a SICAF, a contractual fund, FCP, or even partnership forms like the SCS or the SCSP, the Special Limited Partnership.
Minimum capital.
Similar to UCI, it's an amount, EUR 1,250,000 in net assets, but they have longer to reach at 24 months after being set up. That time frame was also extended from 12 months in 2023.
More breathing room.
And
investment rules. Leverage.
RAIs can invest in a very wide range of assets. They have a choice, essentially.
A choice.
Yes, they can opt to follow risk spreading rules, similar to a SIF, typically a 30% limit per issuer.
Whoa.
Or if the RAI's sole objective is investing in risk capital, like private equity or venture capital, it can follow rules similar to a SICAR, meaning no mandatory diversification.
Interesting flexibility. And leverage.
Permitted. RAIs can use leverage.
Okay, next up, SEFs. Specialized investment funds. How are they different from REIs?
The main difference is regulation. SIFs, governed by the law of 13 February 2007, also amended in 2023, are directly authorized and supervised by the CSSF.
So direct oversight, unlike the RAF.
Precisely. That's the core distinction.
Investor eligibility, same as REIs.
Yes, exactly the same well-informed investor definition applies, including that EUR 100,000 minimum ticket for the other category.
Structure and capital for SIFs.
They can be FCPs, SICAs, or SICAFs.
Yeah.
The minimum net assets are also EUR 1,250,000, and again, they now have 24 months after authorization to reach it, thanks to the 2023 change.
Any paid-up capital rule.
Yes. For SIFs, at least 5% of the subscribed capital needs to be paid up at launch.
Investment scope. Leverage.
SIFs can invest in basically any asset class.
Yeah.
However, they are generally subject to risk diversification rules. That 30% limit per issuer is the usual benchmark, detailed in CSSF Circular 07309.
And leverage for SIFs.
Also permitted, yes. SIFs can be leveraged.
Right. Finally, in the AIF trio, SICARs. Investment companies in risk capital. These are the PEVC specialists.
Exactly. SICARs, under the law of 15 June 2004, again, amended 2023, are purpose-built for risk capital investments. Think private equity, venture capital. They were CSS authorized and supervised.
Key feature.
Their specific focus on risk capital, and importantly, they benefit from a tax regime that doesn't require mandatory risk diversification. Big plus for PEVC strategies.
Investors. Still the well-informed crowd.
Still the same well-informed investor definition, yes, including the lowered EUR 100,000 threshold for the other category after the 2023 update.
Legal form for SICARs.
They have to be corporate structures, so SA, SARL, SCA, the partnership limited by shares, or a cooperative setup as an SA, Coupe SA.
Capital requirements here. Different.
Yes, a bit different. Minimum subscribed capital is EUR 1 million. And like the others, they now have 24 months post-authorization to reach this, extended from 12 months.
Paid up requirement.
Yes, at least 5% of the nominal value of each share must be paid up.
And investment focus, risk capital definition.
They must invest in risk capital. It's defined quite broadly, basically contributions, equity or similar, to help launch, develop, or list companies, direct or indirect investments.
And diversification, leverage.
As mentioned, no mandatory diversification rules. That's key. And yes, SICARs can use leverage.
Excellent breakdown of the main fund types. Now let's talk about how these AIFs actually get financed beyond just investor equity, common techniques.
Sure. A very common tool, especially in private equity funds, is the subscription line or capital call facility.
Sublines, how do they work?
Essentially, it's a short-term credit line from the bank, secured by the investor's legally binding commitments to provide capital when called.
So it bridges funding gaps.
Exactly. The fund can draw on the subline to make an investment quickly and then call capital from investors later to repay the bank. Smooths out cash flows.
Is that considered leverage under AIFMD?
Generally, no. If it's short-term and fully covered by those uncalled commitments, it's typically excluded from the main AIFMD leverage calculations.
Okay. What about other forms of debt or leverage?
Well, funds might also use NAV facilities, net asset value facilities.
Secured by the investments themselves.
Precisely. These are loans secured against the fund's actual investment portfolio. It's NAV.
And used for what?
Various things. Maybe to increase investment capacity beyond committed capital, potentially juice returns, provide liquidity for redemptions in open-ended funds, or cover expenses. More strategic, longer term, perhaps.
And these do count as leverage.
Yes. NAV facilities and other forms of more permanent borrowing are included in the AIFMD leverage calculations.
So fund managers using these tools need to be careful about regulations.
Absolutely. Several key things. AIFMs have to calculate and report their leverage to the CSSF using both the gross method and the commitment method laid out in AIFMD.
Transparency too.
Crucial. They need to disclose leverage levels, maximum permitted leverage, any collateral reuse arrangements, guarantees given all that needs to be clear to investors in the offering documents and periodic reports.
And the fund's own rules.
The fund's constitutional documents, the prospectus, the partnership agreement, must clearly state the borrowing powers and any internal limits.
What about managing the risk, especially for funds that allow redemptions?
For open-ended AIFs, using leverage needs to be consistent with their liquidity risk management policy. You can't have leverage potentially preventing you from meeting redemption requests.
And the CSSF expects good governance around this.
Definitely. The CSSF expects AIFMs to have strong internal risk management processes to monitor and control the risks linked to any fund financing activities.
Okay, brings us nicely to the cutting edge. What are the absolute latest updates and things on the regulatory horizon? We're talking early May 2025 here.
Big changes are coming, particularly with AIFMD2. Implementation is expected by Q1 2026.
AIFMD2, what's the focus?
A major part is introducing harmonized rules, specifically for loan-originating AIFs. So funds that mainly originate loans or where originated loans make up at least half their NAV.
New rules for debt funds, essentially.
Pretty much. Key changes include leverage caps.
Caps, how much?
175% for open-ended loan funds, 300% for closed-ended ones. That's calculated using the commitment method.
Do sublines count towards these caps?
Generally excluded, same as under AIFND-I if they meet the criteria.
What else for loan funds? Risk retention.
Yes, a skin in the game rule. If the AIF originates a loan and then sells it on to third parties, it generally has to retain 5% of the loan's notional value.
Interesting. Diversification rules, too.
Yes, a limit on exposure to a single borrower. Typically 20% of the AIF capital if the borrower is another financial firm, AIFs or UCIs. There are exceptions in ramp-up periods, though.
Any restrictions on who they can lend to?
A prohibition on lending to connected parties, the AIFM itself, its staff, its delegates, the depository, group entities, conflicts of interest concerns there.
What about existing funds? Grandfathering?
Yes, there are transitional provisions. It depends on when the funds started raising capital. For instance, funds that started raising capital after April 15, 2024 generally have until April 16, 2029 to comply with the new rules or maintain existing higher leverage levels if applicable. It's quite detailed.
Okay. Any other general AIFMD2 changes?
Yes, updates around delegation rules, more focus on liquidity management tools, open-ended AIFs will need at least 2 LMTs available, and tweaks to supervisory reporting.
So AIFMD2 is a big one to watch. What else is fresh in Luxembourg? LTIFs.
Yes, LTIF 2.0. The new EU regulation has been implemented into Luxembourg law. The local law, Draft Law 8387, actually took effect back on February 10th, 2025.
LTIF 2.0 European Long-Term Investment Funds. What's the gist of the changes?
It's designed to make LTIFs more attractive and accessible. Broader eligible assets, much easier for retail investors to get involved. No minimum investment ticket anymore. Simpler distribution rules.
More flexible.
Yes, more flexibility on portfolio composition, diversification, and a continued focus on managing liquidity appropriately for these long-term, often illiquid assets.
How are they typically structured in Luxembourg?
Often using the existing Part 2 UCI framework. That's a flexible, regulated fund structure that works well for LTIFs.
We also touched on legislative changes back in 2023. Can you recap the key ones quickly?
Sure. The law of 21 July 2023 did two main things relevant here.
One,
It officially lowered that minimum investment for the other well-informed investor category in REIFs, SIFs, and SICARs down to EUR 100,000.
and two.
It extended the deadline for REIFs, SIFs, and SICARs to reach their minimum capital or net assets from 12 months to 24 months. Gives them more runway.
Helpful changes. What about recent CSSF circulars or guidance? Anything else beyond the NAV error one?
Yes, Circular 24854 came out in February 2024. That gave guidelines on the AML-CFT summary report, the RC report.
And FAQs, are they keeping those updated?
They are. The FAQ on UCI administration, linked to Circular 22811, was updated. Version 4 became applicable in April 2025. And the AIFM law FAQ got an update too. Version 23 came out in November 2024.
And the underlying AML law itself?
The consolidated version of the main AML-CFT law was updated and republished in February 2025. So always important to work off the latest consolidated text.
Okay, stepping back a bit. Any other notable laws or market trends as of now, early May 2025?
On the legislative front, there was a law in April 2025 about the statutes of international financial institutions based here. There's also a draft law floating around about financing EU renewable energy.
Those drafts?
Always. A draft law on income tax from late 2024, and another one potentially extending some housing market fiscal measures. Things are always moving.
And market trends. What are industry bodies and firms seeing?
Well, ALFI and Broadridge recently confirmed Luxembourg's continued lead in global cross-border fund distribution. No surprise there, perhaps. Strong momentum. LTIF 2.0 is definitely generating buzz, often using those Part 2 UCI structures. The 2023 rule changes are seen as enhancing flexibility, too.
Economic outlook?
Some optimism, maybe. LPEA, the Private Equity Association, suggested 2025 could see a potentially more favorable macro environment for PE and VC compared to the last couple of years.
And specific legal updates firms are tracking.
Pillar 2 global minimum tax is a big one. DC9 implementing it came into force just recently, May 6th, 2025. Also, relevant court rulings from places like the Netherlands impacting holding structures and general M&A activity, like the planned listing of Terra Innovatum. Lots going on.
It really is a constantly shifting picture in Luxembourg's financial world.
It is. But Luxembourg's enduring appeal really comes down to that flexibility. The SOPARFI is a versatile holding tool, the diverse fund toolbox with UCITES, RAI, SIFs, SICARs, each with its own approach to capital and finance, all within a pretty robust regulatory system.
And system that keeps adapting.
Exactly. The way Luxembourg proactively adopts things like LTIF 2.0, prepares for AIFMD2, refines its own laws like in 2023, and provides ongoing CSSF guidance. That's what keeps it competitive and accessible.
While still focusing on protection.
Absolutely. That strong focus on investor protection and market integrity runs alongside the innovation. It has to.
So, looking ahead.
Look, Luxembourg seems really well placed for more growth, especially in alternatives. Leveraging LTIF 2.0, the established AIF regimes, finding those innovative financing solutions, that's the path forward.
And the key skill.
Being able to structure capital efficiently and navigate this evolving regulatory landscape that's going to remain absolutely critical for success in Luxembourg's financial sector.
A fascinating deep dive. Thank you so much for sharing all that insight.
My pleasure.
And thank you for joining us. Don't forget to hit that subscribe button so you don't miss our next exploration. It was the Luxembourg Fundcast for you today.